Welcome to this at-home edition of the Stock Play of the Day. Today's stock is Disney. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsey, a lot of things happened last week in the markets, just like the few weeks before that. So we have a chart of the S&P 500 index up. What are you seeing in the markets this week?
Yeah, I mean, last week there was a lot of green. Look, the S&P 500 is up 25% off of its lows in a matter of 3 weeks. Last week we saw the S&P 500 jump over 12%. And, you know, investors cheered that move. Sentiment seemed to have changed. A lot of it had to do with, progress that was being made with regards to the coronavirus situation. Cases seem to be stabilizing to coming down, even though deaths are still rising. Dr. Fauci was on the Sunday news shows yesterday talking about how he was cautiously optimistic about restarting the economy. But also last week we had, another big shot in the arm, I should say, from the Fed, putting more liquidity in the markets. Obviously, investors like it's kind of don't quite that type of environment when you think about the broader index. Today, though, like I mentioned, we are seeing some red, and it might just be a little bit of give back after that big move that we saw last week and really over the course of a 3-week period. We're going into this week. We're going to get a little bit of economic data. The big story this week is that we're going to get into earnings season. We've got some of the big banks reporting, and maybe we'll talk about that as the weeks go on. But you'll hear from JP Morgan kicking things off. And then Goldman Sachs and Bank of America too. So they'll have a good feel for us about what the economy is doing, what the consumer is doing, how they're feeling. They've been processing a lot of these small business loan application requests, as well as mortgage requests. The government did put into part of their CARES Act the ability to push off your mortgage payment by 90 days with no penalties. So the banks have been busy, that's for sure. We'll hear about what's doing well and what's not doing well from their perspective. The other big news, by the way, Brian, over the weekend was you and I talked about some of an energy stock a couple of weeks ago, Exxon, we took a look at. Over the weekend, it was the US, Russia, and Saudi Arabia got together to commit to production cuts. We're still waiting to see more details on that. Overnight, we saw the energy oil prices spike, but they've come back down and they're not doing too much today. So that's one thing that catch my eye in morning trading too. But we'll see, it's still early in the day. You never know where we're going to end up. So just a lot of different things going on as usual. But we're coming off of a really big ramp in the market last week. I wanted to mention too, I've been talking about the Russell 2000. It had an extraordinary week last week, up 24%, I think. So maybe that's off the bottoms, probably. But that one had been laggard, right, Brian, in the past?
Yeah, like with the Russell 2000, we mentioned last week about the 20-day moving average. It was kind of weird that the SPX had bumped up against it. The NASDAQ had crossed through the 20-day moving average. And we kind of made note that if the Russell 2000 index could actually make that move and close to the upside, and it did, and then it continued on up and actually showed some strength. Now, I definitely think it had to do a lot with the stimulus of the government coming with the PPP program where they're giving basically free loans to small businesses that are using it to hire people. And then we also saw in the S&P 500 index a 50% retracement last week after the big run up. And I'm going to highlight that on the chart, but it was right about the 2,800 level. Basically, that would be from the lows since the big downturn, since all the stuff started happening in the marketplace. So I kind of can understand why we're getting a little bit of a bounce off of that 50 50% retracement level and seeing a little bit of a weakness in the marketplace, it'll makes a little bit of sense technically that is happening. But that's a little bit normal. You see all the way down to about the 2200 level, bounces all the way back up to the 2800 level, and now we're just seeing a little bit of weakness in the marketplace.
Yeah, I mean, I feel like we've talked about this. Investors are really, the technicals matter so much in this type of market when there's so much uncertainty about the fundamentals in the future of the economy and profitability of companies. So it's a good point that you make there.
All right. So questions from last week. All right. I just want to let you guys know that we are answering your questions. So please keep typing them into the chat box, and we'll address them the following week. And I think we had one question, Lindsey, last week from last week's program.
Yeah, we got some really great questions. Again, we're doing this at-home edition, so we can't answer them live, but we definitely want to keep up and make sure that we're answering our viewers' questions. Last week, somebody asked about the liquidity in the options market, given the significant amount of volatility that we've seen. Brian, you're the options expert. What does this mean for the pricing of options?
Well, to start with, let's just kind of talk about the great question, because it was a very astute question, what liquidity means in the marketplace. Well, first of all, in the options world, liquidity is a bigger issue than in the stock world, because there's a plethora of different option contracts that trade, obviously, on one underlying. So because of that, when you're looking at the bid price, the price that you're selling at, and the ask price, the price that you're buying at, what we're talking about is the width between the bid-ask spread. And if you look at the options marketplace on even liquid stocks, Apple, Facebook, a lot of these very liquid stocks still have wide bid-ask spreads because of the volatility. The more volatility there is in the marketplace, the more risk the market makers have because of the quick moves in the underlying stocks. So a lot of times those bid-ask spreads will just artificially widen, mainly because the stocks are moving so fast. So there's no great way to address it. The things that we've been talking about on the stock play of the day, it does help if you're spreading options, if you're buying one option contract and selling another option contract at the same time. A lot of times the market makers will work with you because you're giving them a buy and you're giving them a sell. You're giving them two bid-ask spreads, and on top of it, they're usually going different directions. So it's an automatic hedge for them. So overall, as you've seen on a lot of the stock plays of the day, we've been talking about spread trading, which we're actually going to be talking about today. We're going to look at a spread in Disney. It'll be a short spread. So let's jump into Disney stock. Let me pull up the chart on Disney, Lindsey.
Yeah, pull up the chart. Disney is our stock play of today. And yeah, I mean, it's hard in this environment really to talk about the fundamentals of individual securities, which is, what my bread and butter is. It's, what I grew up doing. But, Disney has always been considered a really high quality stock in the marketplace. And it's gotten pretty beaten up in this downturn that we've seen. So since it reached its peak actually in November, and it was kind of like drifting lower for a little while, and then kind of went a lot lower with the market. It ended up being down 48% from that November peak to its March bottom. You see there on your chart. It's since bounced about 32% off of that low. And, again, this is just one of those high quality names. There's been a trend in the marketplace to purchase high quality stocks in this period of uncertainty. But when you think about the fundamentals of Disney's, it's a little bit difficult because their biggest money maker is the parks, right? The parks, and then they have their studios that do well. And then their networks. It's the parks and the networks that really drive the business for them. And the parks have been shut since mid-March. And there's not really any clear path to when they'll be open. If you were to, Brian, if you wanted to take your son and go on a trip to Disney, the earliest time you can book it would be June 1. So that could be the soonest that they open. We don't know what their opening plan will look like, but not having that the parks open and generating income is certainly going to have an impact on their earnings and profitability this quarter. The studios haven't been making movies. But on the bright side, the one thing that you do have holding up this stock is their newest business line, which is the Disney Plus. We heard last week from the company that they crossed 50 million subscribers to the Disney Plus channel in this coronavirus environment where people are staying at home and they're watching a lot more TV than they ever have in the past. So that's really good news. The company has really made an effort to move forward. I guess the production of some of their movies that they weren't expecting to put on Disney Plus until later in the year. They brought those forward, like Frozen 2 is one of them that is brought forward 3 months for people to start streaming for their kids while we're in this situation. Onward is a Pixar movie that is going to be up there much sooner than expected, and really they've been focusing on getting movies that might have went to the theater or onto Disney Plus for people to enjoy from the comfort of their own home. We don't know when people are going to go back to the movie theaters, right? And also the networks, Brian. ESPN has been a big moneymaker for these guys. And while there's no sports going on right now, they're still receiving their licensing fees there. And they've been really good about pulling some things like their special on Michael Jordan, I think was live on April 19th, which again is a few months before it was anticipated to go live. So they're doing what they can. And again, this is a company with a really solid balance sheet, which bodes well for them in this period of time. My only concern is, as you see here in this chart, the stocks come down significantly. We also know, I took a look at earnings, Brian, 37% cut in earnings per share at the estimate of earnings per share for 2020. So that's a pretty big cut, and their fiscal year, by the way, ends at September 30th. So with 6 months left to go, analysts really cutting numbers, the stock's really coming down, but guess what? The valuation is really pretty high. They're trading at a PE multiple of 36 times. That compares to its 10-year average of about 17 to 18 times. So my worry with this stock, given that they have, they've had to shut down the majority of their business, I worry that the numbers could come in a lot lower. The stock could also come back in, maybe retest that low that we saw in March, which is why you're taking a look at the spread trade that you are looking at, right, Brian?
Right. And if I'm just going to highlight a little bit on the chart too, all those things that you've said, there's obviously nervousness in the marketplace because we saw the 50% retracement come back in the SPX. We also seen strong movement because of the government programs, mainly in the Russell 2000 index. But Disney really hasn't made that move back. It's only gone back to about its 30% retracement level, or 38%, I should say, as opposed to the 50%. So there is still a little bit more room to move, but we understand why, because of a lot of things that you were talking about. So once again, we're going to highlight the FOMO trades. This has kind of been the theme in all of the stock plays of the day. Just fear of missing out. If you have capital on the sidelines, how can I use options to allocate it and take advantage of some moves maybe to the downside, like in Disney? So for example, we're going to sell a short put spread. It's going to be considered like a cash secured put. And we've talked about that in Exxon. You already mentioned Exxon. Selling it below where the current stock is trading, saying that if the stock comes to that level, we wouldn't mind the stock being put to us at that strike price, and basically buying the stock at a lower price. There's so much volatility premium in the option contracts. We still got the VIX trading above 40. It's right around 45 as we tape the show today. And if we think about that volatility premium, we want to try to take advantage of it. And that's where the fear of missing out. We want to be able to find a trade that says, well, if Disney goes a little bit lower, we're willing to buy it. Now, because of other things that you mentioned, I'm not quite that comfortable to just sell a put saying I'll buy at a specific price. So we're going to buy some protection below. We'll take some of the credit from selling the put, and we will use that credit to buy some protection. So let's look at how this trade all plays out. So first of all, if I pull up the chain on Disney, we see that right now it's down $4, about 3 or 4%. So a little bit more than the market is right now. The short put spread inside the options playbook looks like this, in that we are selling a put at strike B. We're selling the more expensive put The stock is somewhere up here on the profit and loss graph. And we're saying if the stock comes down to this level, then our risk is going to kick in. And we're going to have risk from strike B, the more expensive, down to strike A, the less expensive. So we'll use some of the credit from strike B to pay for strike A, and we're going to only play between B and A. All right. So now let's go in and look at the option chain. I guess I didn't need to, I'm a poet and I didn't even know it. All right. So
Sure are, Brian.
Disney here. Let's look at, we're going to go out to the May 1st expiration. One of the big things about having this type of volatility is we really don't have to go that far out in time and get decent credits because of all the jacked up implied volatility. And if I'm looking at Disney, it is one of the stocks that hasn't came off as much as implied volatility. We saw last week we were talking about PayPal. It went from 100% implied volatility all the way down to 50%, and they were going to be announcing earnings soon. So we had a huge drop off in implied volatility going into earnings. This week we're looking at Disney, and we see that the implied volatility, the option that we're selling here, is right around 68%. This is the put chain for the May 1st expiration, 18 days away. The at-the-money volatility is around 60%. So we've seen a drop, but we haven't seen a tremendous drop off in implied volatilities like we have in some of the other blue chip stocks around. All right, so here's what the trade is going to be for the week. Inside the Ally Invest option chains, one of the things that I want to look at, if I'm trying to figure out how far to go out of the money on my short put spread, I want to look at what is the at the money straddle chain trading for. That will give you what's quote unquote called the expected move. What's the marketplace think that Disney could move by this expiration date? And I'm just going to round off here. We got about 520 here, about $5 at the midpoint here. So we're talking about $10.20. About 10% is what they're saying this stock can move over the next 18 days. So that's obviously a big move in an 18-day period. So we want to go beyond that. So we're going to look at going down below about 10 points down. And we see here we're going to be selling the 90 strike put. And then we're going to be buying our protection at the 85 strike put. If I scroll all the way down to our workbench here inside the Ally Invest option chains, we're going to be getting this done for about 80 cents. So the total cost of this trade, if we put this on, is going to be the width between the strikes. As you saw in the options playbook, that's our risk. And in this instance, we're going to have 5 points worth of risk. Now, if we can fill this at the net credit, and I'm going to call it 80 cents, that's basically what my notes were from doing the trade. Right now it's at 77 cents. We're hoping to fill somewhere at the midpoint. Now that goes to the liquidity question that we had from last week. I would want to fill this trade a little as close to the midpoint as possible. Now, that just means you're going to put in a limit order. You're going to say we want our net credit around 80 cents, and we just hope that the trade fills. If it goes away from us and it moves, oh well, we'll find another trade at a later date. Just don't get hung up on it. But you see the width of the bid-ask spread here. We're talking about 60 cents by 90 cents. It's 30 cents wide on the spread. That's why we like to do spreads in this instance, to try to get those better fills, get a little bit better midpoint pricing, if we will. And we're more apt to get that if we add additional legs to our strategy. That's just in general. So let me scroll down, and we're going to look at our profit and loss graph here inside the Ally Invest platform. And we see here's where the stock is currently trading, up at this level. This is where we're saying we're willing to buy it, at the 90 strike level. And where we don't want to play anymore is from 85 on down. So from 85 to 90, that's where we have our risk. So that's going to be how much we're going to have held out in our brokerage account to place this trade, which is $5 minus an 80-cent net credit, or $4.20. But the concept here is that we're willing to buy Disney. So you want to be able to buy 100 shares of Disney at 90 if you're still bullish on the company overall. We're hoping that the stock would come down to this level, give us that opportunity to buy 10% lower than where it's currently trading at. So let's look at, that's going to be the official paper trade for this week. And as always, it's not meant to be a recommendation. We're just learning here on the stock play of the day. But let's go into the Ally Invest actual trade ticket here, and we'll review this trade overall. Okay. So we have Disney right now. It's trading at 100.49. It's down $4 today. We're looking to buy the May 1st expiration, 18 days away, 85 strike put, sell that same expiration 90 strike put, hoping to get it done. We set a net credit of 80 cents. The market has moved a little bit, and now it's a little bit below that, but we'll keep it there. A nice net credit of 80 cents would be solid. Our maximum upside is that 80 cents or $80 for every 1-by-1 spread that we do. And don't forget to add commissions in. And then on top of that, our maximum risk would be that 80 cents minus the $5 width of the spread, which is $4.20 overall. All right. Well, that was kind of short and sweet for the option trade today. Since we're not taking questions live because this is the at-home edition of the Stock Play of the Day, keep typing them in. We will review them just like we did in this show, and we'll address them in next week's show. But let's get back into the summary, Lindsey. Let's talk about the S&P 500 index one last time and do a little.
Yeah. Today, you know, like you said, we're taking a little bit. Looks like the market's taking a little bit off the table here. We're at that 50% retracement level, as described by the Fibonacci levels. And so it seems like a natural place to take a breather here. We're getting into earnings season. We'll see how the rest of the week unfolds, but you know, earnings is probably going to be a tougher period for investors to digest this season. Brian, how about the trade for Disney?
Yes, we're definitely going to see some surprises in earnings. There's no doubt about it. And that's going to be the next, I guess, the big headlines are these companies are going to be coming out announcing earnings, and some of them are going to blow it out of the water, and some of them are going to just sink totally. So Disney, let's talk about that stock. What are we seeing in Disney? Quick summary.
Yeah, the quick summary is it's a high quality name. It's a high quality stock, but they do have some near term pressures to their operating business with regards to the parks and the cruise lines and even the studios to a lesser extent. But the networks and that Disney Plus, that's where the silver lining is near term.
All right. And then once again, we have a FOMO trade, fear of missing out. How do I allocate capital when the market is down and I'm scared about the marketplace?
Right.
We're trying to show you trades where you could end up buying stocks at lower prices than where they're currently trading. And we're doing this getting paid saying we'll buy Disney 10% lower than where it's currently at. All right. Well, that's it for this Stock Play of the Day edition. We'll see you same time, same place next week. And if you can, don't forget to add your questions. We will address them in next week's at-home edition of the Stock Play of the Day.
See you next week.